Hi, everybody. Hope you're enjoying the extension to your spring break and probably have a lot of questions about how the rest of this semester is going to go. Um, Actually, I kind of join you in having those questions, but it's been an interesting process to think about that. And I think actually it's going to be kind of interesting and hopefully kind of fun as we experience a different kind of dynamic as we go through this class. Um, I sent you an email with sort of a game plan that we're going to have. You've got your homework solutions, you've got the textbook. I sent you an announcement about how to access the e-textbook that the publisher is making available if you don't have your book with you. Um, we have the online quizzes, and we'll continue with that. And I'm also going to be making some videos, such as this one, to help introduce you to some of the material. So I'll try to make it in short segments that are easier to digest. Um, we will see how short I'm able to do it. I'm going to try to keep that in mind and try to not just be a talking head for that goes on and on forever. So in this first one, I want to give you a quick little overview of the first topic in Chapter 5, which is how to reconcile a bank account. And I think of everything we talk about this semester, this is perhaps one of the most immediately beneficial topics that we'll talk about. Because if you haven't already had a bank account, you will have one, and you need to reconcile that on a regular basis. Um, so, let me get me out of the way here. We have talked quite a bit about our cash account. That's an asset in your ledger. That cash account is actually representing a bank account because you're not going to have a bucket of a bunch of cash in the office. But when you get money, you're going to deposit that into your business bank account. So if you have several different bank accounts, you would probably create a different ledger account for each one of those. So let's assume we have a bank account, say at First Financial, and so anytime we make a deposit, we're going to add to our cash account, and of course the bank is also going to add to our balance in their records. Now if you think about it, the bank, when you put money into the bank, that's money that the bank owes back to you. So your account on the bank records is actually in their liability section because they owe that money back to you. When you deposit more money, that increases their liability to you. And when you take money out, of course, that decreases it. Periodically, the bank will send you a bank statement to typically at the end of every month to let you know what your balance is and to summarize the activity that's in your account. And what you want to do every time you get a bank statement is reconcile what the bank says you have to what you say you have in your records. We call that a bank reconciliation. So here's an example of one right here. The balance that you have in your account, we call that the balance per the books. And so that would be, again, whatever the ending balance is, say we have on December 31st. And then we're going to get a bank statement as of the end of the month, and it will also indicate how much we have, but those two numbers may be different. So what we're going to do is reconcile those two. And to reconcile them, we're going to add and subtract from both balances. And when both numbers are completely up to date, then what we say we have and what the bank says we have should be equal. So this would be our reconciled balance, and the two, once updated, should be equal. So we're going to look at a simple problem to do that in just a minute. But before we do, let me define a couple of terms. When you write a check and that check gets processed by the bank, they will stamp that check as being paid. And we call that a canceled check or a paid check. If you write a check and that check is still in the hands of whoever you gave it to, then the bank doesn't know about it yet, and we would say that that is an outstanding check. In other words, that check is still out there. It has not yet been processed by the bank. If you write a check and you make a mistake on it, like maybe you make it out to the wrong person or you make it for the wrong amount, then you're going to want to tear that check up or destroy it in some way so it can never be used. We call that a void check. Sometimes people get a void check confused with a canceled check. A canceled check is a check that has already been paid by the bank. A void check is a check that will never be paid by the bank. It's been destroyed so that it can't be used. Sometimes a customer may give you a check and you deposit that into your account, and it turns out the customer didn't have enough money in their account to cover it. So that check would be returned to you and it would be stamped NSF, which stands for non-sufficient funds. So again, this is a check that a customer gave you. It would be returned to you because that's your documentation that customer gave you a bad check. Of course, if you wrote a bad check, then let's say you wrote a bad check to United Grocer, then that bad check would be returned to them because that indicates that's their documentation of the bad check that you gave. So those are some terms that we will use in our discussion. And now let me... Okay, so we've been through some general terms, and now what I want to do is go through a simple, if I can get over there. Okay, I think I figured it out. Okay, so now I want to go through a simple little problem with you and how a reconciliation would work. So here's the situation. As of December 31st, the books of Acme Company shows a cash balance of $37.84. That's what I have here as our balance per books. It says, however, the bank statement on that same day shows a balance of $65.28. So that would be our balance as per the bank. So our books, which comes from our ledger, our books say that we have $37.84. The bank says we have $65.28. We're going to update both of those numbers in order to reconcile the two. So here's the additional information. Outstanding items as of December 31 include deposits of $2,559 and checks of $58.23. The bank statement contained a service charge of $35 and a customer check marked NSF for $485. So what amount of cash should appear on the balance sheet? These outstanding items, outstanding deposits of $2,559, those represent amounts that we deposited maybe into the night deposit box, but we didn't get them in there in time to get onto the bank statement. So they would be outstanding as far as the bank statement goes. We also had checks of $58.23, checks that were outstanding, checks that we wrote that have not yet been processed by the bank. As soon as they get to the bank will subtract those from our balance. And so we're going to go ahead and do that. We're going to update the bank balance for these outstanding items. In addition, the service charge and the customer check that was returned NSF, those are amounts that need to be subtracted from our books. The service charge is simply a $35 charge that the bank is charging us for the month. And then this bad customer check, remember we had made a deposit, we had added that to our balance, and now that check comes back to us because it's not any good. So we're going to subtract that back out. And so when we bring all these, both of these balances forward, the reconciled balance is $32.64. However, in our cash account, it still says $37.84. Everything in this column needs to be recorded in order to bring our ledger up to date. So here's how we're going to do that. So here in our journal, we're going to, these two items, again, everything in this column needs to be recorded. It's just these two items here. Both of them represent a minus to cash. So both of them would be recorded with a credit to the cash account. And then the debit for the first item would go to a service charge expense. That's for that bank charge. And the other item, the $485, that'll go to accounts receivable because that customer still owes us that money. Remember, the check was no good. They still owe us for that amount, and so we're going to put it back into accounts receivable. These journal entries will be posted to the ledger. I've only got the cash account here, but when those two credits are recorded, that would bring the cash balance up to $32.64, which is what we had reconciled to, and that's the number that would go to the balance sheet. Okay, that's the introduction to the bank reconciliation. In the next video, we'll look at a more involved problem.